Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone. We've just released our monthly India Market Outlook titled Riding a Policy Boost. My name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank India, and I'll be your host for this podcast. In today's episode, we discuss a key question on investors' mind. What are the implications of the RBI's recent policy announcement on Indian assets? Well, in its latest monetary policy meeting, the RBI surprised investors with a higher than expected 50 basis points policy rate cut. Further, the RBI announced a lowering of the cash reserve ratio or the CRR requirement for domestic banks to 3% from 4% of net demand and time liabilities, implemented in tranches of 25 basis points with effect from 6th of September to 1st of November of 2025. Arguably, this was more dovish than what market expectations was ahead of the policy meeting. However, the RBI's decision to change policy stance from accommodative to neutral, along with forward guidance indicating limited space for further easing, was more hawkish than market expectations. In our view, these recent policy actions marks a decisive shift in the RBI's outlook towards growth inflation, with likely positive implications for Indian assets. The CRR cut of 100 basis points is likely to boost banking system liquidity by INR 2.5 trillion. This surge in liquidity should help in better transmissions of the front-loaded rate cuts and lower policy rates, unlike in the previous rate cut cycles. Equity fundamentals have improved amid better relative valuations. Easing financial conditions amid a benign inflation outlook and supportive fiscal policy should help support the ensuing recovery as seen in the fourth quarter of fiscal 2025 delivery. Nifty 12-month forward price to earnings ratio, currently at around 20.5x, is stretched compared to its 10-year average of 18.2x. However, relative to bonds, we find the yield gap still in favor of equities, supporting our overweight view on equities. We expect forward returns to be muted compared to the post-pandemic recovery cycle, but higher than other traditional assets driven by robust earnings outlook, which for the Nifty index stands at around 12 to 13% CAGR over the period of fiscal 2025 to fiscal 2027. Coming to bonds, we expect carry to be the main driver of returns going forward. The change in policy stance to neutral indicates limited policy easing in the remainder of fiscal 2026. We expect the yield curve to steepen further, which means shorter maturity bond yields will fall more than longer maturity bond yields given ample liquidity. We close our preference for medium and long maturity bonds. We continue to have a preference for high quality or AAA rated corporate bonds as the yield premiums are still attractive, with around 85 to 90 basis points spread still available over government bonds compared to the 70 basis points 10-year average. This makes them a candidate for better absolute and relative performance going forward. On a cautious note though, global policy uncertainty remains a key risk. We believe a diversified asset allocation through multi-asset strategies remain a prudent approach to tide through an uncertain market environment. That's it in this edition. Do reach out to your relationship manager for a copy of our India Market Outlook. You could also find us on our website at the Standard Chartered Market Views on the go or in the SC Invest section of our online banking portal at sc.com/in. Thanks very much.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.sc.com/in.